Sometimes, in the face of tragic world events, the work we do here seems a little trivial. We started doing these videos 2 years ago as the world first ground to a halt at the onset of the pandemic. At the time, we assumed the housing market would crash. So we wanted to be able to share what we knew as soon as we knew it. We were able to quickly observe that that wasn't happening, and we are able to adjust our conclusions. The real time data turned out to be really incredibly useful. So now we're faced with another global crisis, and the Russian war in Europe seems less likely to directly impact our little corner of the economy, but we actually can already see impact. And although it does feel a little trivial, we're going to keep doing our work here and hopefully bring some value to the world. Each week, Altos Research tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. Traditional data is real estate data is released monthly, and it's backward looking, and so by the time it gets to you, it's kind of old news. So I'm Mike Simonsen. I'm the CEO of Altos Research, and let's look at the U.S. real estate market and see the details for the week of March 7th, 2022. Home prices are climbing now rapidly, as you'd expect for this time of year. The median price of a single-family home in the U.S. this week is $395,500. That's up just over 1% from last week and 12% from last year at this time. Home prices are rapidly approaching $400,000, and it'll be fascinating to see when they cross that psychological barrier. In 2017, prices stayed at $299 all summer long. They finally crossed $300K in March of 2018. So you can see that long plateau in the dark red line, 2017 here. It'll be really interesting to see that pattern falls again. Prices last year peaked at $399, but didn't move above it. So the median price of the new listings, that's the light red line here, is up to $399 and up only $100 from last week. So the demand is clearly there. And so we'll see when prices actually move above that $400K barrier. Next couple of weeks, I presume. We also track rents here at Altos Research. Here's a chart of asking rents of single-family homes and apartments over the last year. Single-family homes rent currently $2,100 median. That's up 17% from last year at this time. I wanted to share this because there's some conventional wisdom that says that purchase and rental demand should be inverse to each other. That like when we have demand for home purchases, demand for rental units would fall. But it turns out that they mostly move in tandem. Both are driven by household formation and demographics. In a recent Top of Mind podcast, Bloomberg columnist Connor Sen coined the term under-householded. So the massive housing demand right now is catching up to many years of the proverbial millennials living in their parents' basements. They're now finally forming households, and that's driving real estate demand, both purchase and rentals. Likewise, when the housing demand finally cools, it'll cool the rental market as well. By the way, the Top of Mind podcast has been super fun for me. I get to interview the best thinkers in the real estate industry and build the context around the data. This week, I interviewed Dan Green, the CEO of mortgage lender homebuyer.com. We explore some really interesting nuances in the mortgage industry and big changes that we're seeing happening right now. It's a great podcast. Check out Top of Mind at all your podcast places. Inventory has fallen to only 241,000 single-family homes unsold on the market right now. Each week we add maybe 75,000 new listings and we sell 77,000 more. So there are no signs anywhere in the data yet that this trend is slowing, let alone reversing. So at this point, gotta expect inventory is going to keep declining probably till the end of May, or end of April, like last year. And if that's the case, then we'll probably go as low as 222,000 homes active on the market. At this point, we are still assuming that mortgage rates mostly climb for the year. They've fallen a little bit as a result of the war in Europe. But rising rates, we would assume, puts a small damper on demand. So we're still forecasting a slight increase in inventory by the end of the year. For more details on our inventory projection, you should join our monthly webinar, which is this Thursday, March 10th at 10 a.m. Pacific. We have an hour to dive into all the details. So join us for that. There's a link to register for the webinar in the description below. That's this Thursday, March 10th at 10 a.m. Pacific. The immediate sales phenomenon is showing no signs of slowing either. It sure feels backed up by all the local anecdotes too. That 23,000 of the new listings this week went into 23,000 that went into contract essentially immediately. I mean, it sure would be encouraging to see the dark red portion of this line start to climb a bit each week. These are the homes listed that are not selling immediately. But we're still in a world of intense buyer competition, incredibly tight supply. And this is an important characteristic to note about housing. Even in a world where rising mortgage rates, they resume their spike, demand's going to take months to slow down. So we've already have the big price growth pretty much baked into the market for 2022, and there are no signals anywhere in the data of any slowdown yet. So it's really, by now we're looking at 2023 is the earliest we should see any price moderation. And that would be just slowing of price growth, not any kind of price adjusting down. So finally this week, price reductions. In 2018, that's when we last had rising rates. Price reductions and inventory were already rising in March in 2018. That's the normal pattern. That's what you'd expect. This time around is not the case. There are only 17% of the homes on the market that have taken a price cut recently. That's down from last week. And the weekly pattern is almost exactly like last year. Fewer price reductions than last week because buyers are in bidding wars all around the country. Price reductions need to moderate a little bit later in March and April so that inventory can start building later in the spring. Demand has to slow some. So I've highlighted 2018 in dark blue here. The rates rose, demand cooled just a touch, and more homes had to adjust their price to account for that lower demand. So that the dark blue line was already rising at this point in the year in 2018, and then finished the year a little bit higher. Now the dark red line at the bottom, that's where we are this year, and it shows the market's still heating up. So this is another signal that even if rising rates slow this market, we won't really see the impact until next year at the earliest. Okay, that's all the data we have time for today. As I mentioned, the link to register for the Altos Research March webinar is in the description below. That webinar is Thursday, March 10th at 10 a.m. Pacific. We look at the entire U.S. real estate market. We look at a lot of the details. So click that to register. We're getting a ton of participants in these webinars each month, so you should join us too. We're going to talk rates and inflation, and we're going to investigate how the other world events are impacting our U.S. real estate market day to day. If you have clients who need to navigate the crazy waters of the U.S. real estate market this spring, you should join us. Okay, see you Thursday. More next week.